Welcome to Trading Central July Technical Outlook. I'm Remy Gossens, Head of Technical Analysis, and with our analyst team over the next 15 minutes, we are going to review a one-month technical scenario on key assets. Connected with us, we have Gary Christie from North American Research, based in Ottawa, Canada. Hello, Gary.
Hello, Remy. Hello, everyone.
We also have Nicolas Suiffet, Head of European Research, based in Paris, France. Hello, Nicolas.
Hi, everyone.
We also have Christophe Chevalier, based in Paris and in charge of Forex. Hello, Christophe.
Hello, everyone.
With them, we will detail our one-month scenario on key assets. Indeed, France winning the Football World Cup is not the only major news. With the analyst team, we will discuss the current short-term bullish trend on European and US equity markets, the strong USD bullish trend with, on the opposite, the bearish trend in place on commodities, mainly precious metals and crude oil. Let's start with the US equity market with Gary Christie from North America Research Desk. Gary.
Thank you, Remy. Let's take some control. All right, so lots has been happening in the US markets lately. For our weekly outlook, not much has changed in that regard and according to long-term view. So we still remain supported by a long-term rising trend line in place since early 2016. We can see that blue 50-week moving average that still maintains support in the uptrend. We have not breached that at all since back in 2016. We did break above this short-term wedge pattern, falling wedge, and we've been continuing higher. We got worried a little bit when we were breaching that 20-week moving average, but it looks like in the very short term, it is acting as support on a weekly chart. So we've broken out of that those recent highs here from that doji reversal we had back in June. And we are looking to test the record highs here, 28.72 in a long-term chart. Then ultimately, we're going to trend higher beyond that to 29.40. Relative strength looks really good here as well. We are still maintaining above 50, trends well intact. They're at 60.9 in relative strength. You got a lot of room here to go before we even reach our previous highs we had back in February. But there's a more interesting story happening on the short term. Let's just flip to that now. I'll show you our short-term layers here. So on a daily chart, a little bit different. So we were bearish for a few weeks at least anyways, and then the market just rebounded quite fast. We were below that 50-day moving average. We had some trouble here, some pressure, as we thought we would maybe test that 200-day moving average, and it never really happened here. So that 2700 area maintains, that support, that low we've had. We haven't been able to breach it. So we've been rallying higher. We had a nice bullish gap that appeared here first week of July, and now we use this as support in the short term, 2764 area from that gap that moved higher. And the reason for this, we keep a nice tight stop, is the fact that we did break above those June highs at June 13th. And so this should resume now. And we also, that was a major top at 2790 area we had tested back in June. We tested it out here back in March after that huge decline we had in February. So we're actually seeing some momentum into the SPX now, and no reasons why we can't see this moving to test at 2872 high. And another reason to maintain a bullish bias, a tool I like to use just to gauge any kind of channel trend is an Andrews Pitchfork. And if you use that ultimate extreme low in February, we can hit a point here, and I'll draw it for you now. We can see that most recent swing high we've had last little few months in April 18th, and we've seen that low from that high here back 25.95 back in May, and it kind of draws us a nice bullish trend channel, and we've reached above half of it. And this also corresponds with that upper resistance line at 2872. We should test this channel before we get any kind of pullback. So this is great to see, this nice linear regression line. We see we're above it right now at 2811 this morning, and we should just trend on higher towards 2872 as long as we remain above at 2764. We would get a little concerned if we broke down below the 2792 area, as this should then maybe retest the support of this channel, but we'll play that if it comes by. For now, we'll maintain a bullish bias. It's a done deal here for the SPX. Let's just hand it over now to Europe, to Nicholas, to see what's happening in Europe. Nicholas.
Thank you, Gary. Let's start with the long-term view on the European market. So you can see on my screen now the chart of the Stoxx 600. Just to remind you that on the long-term basis, as you can see here, the European market is supported by a key rising trend line drawn from 2009, as you can see here. So this rising trend line is a very important technical element, and we can say that the trend remains bullish as long as prices are holding above this key rising trend line, currently around 351, as you can see here. This is the dotted line, but we can also notice that the 50-week moving average here in blue plays a key support role, currently around 366. So this is another key support to watch out closely. So the key support base is set around 366, the 50-week moving average here, and the 351, which correspond to an horizontal support threshold, and also to this key rising trend line one from 2009. So keep in mind that the long-term trend remains bullish on the European market as long as prices are holding above this key rising trend line. However, we can also notice that prices are currently challenging a massive resistance threshold around the 400 mark, as you can see here, the dotted line. So this is a resistance which is in place since 2007. We can see here that this resistance threshold has been tested in 2015 before prices have entered into a consolidation phase. So for now, there is not enough momentum behind bulls to break above this key resistance threshold. So that's why we are a bit cautious on a long-term basis, as long as prices remain capped by this resistance area 415, which correspond to the spike, as you can see here, in 2014. Let's switch to the daily chart, so the short-term basis. This is still the chart of the Stoxx 600, as you can see here. So on a daily chart, on a short-term basis, we became more positive on the European market, thanks to the breakout of the key resistance threshold at 381.80, as you can see here. This is the dotted line. That was a key resistance threshold which has been broken 3 weeks ago. So we have turned positive on a short-term basis, and we can also notice that prices are rebounding within this broadening wedge pattern, as you can see here, and the upper end of the pattern is set currently at 388.80, as you can see here, the green line. We can see also that prices are currently breaking above the 50-day moving average here in blue, so this is another bullish signal on a short-term basis in Europe. And regarding technical indicators, we can see that the RSI is above the 50% area and is not overbought. So that's why on a short-term basis, we may expect a further technical recovery to see at least the 384 mark, which correspond to an horizontal resistance threshold. And in extension, we can expect a retest of the former high in May at 398, as you can see here. Only a break below the 379 mark, so which is the blue line here, would invalidate the short-term bullish bias and would call for a new down leg toward 374, which correspond to the swing low here, and in extension 366, which correspond to the key 50-week moving average on a monthly chart. So that's the view for Europe. On a short-term basis, to sum up, we are bullish. We expect continuation of the technical rebound. As long as prices are holding above 379, the blue line, we can expect, with a breakout above 388.80, a continuation of the uptrend toward 384 and in extension 398. Okay, that's it for Europe. Let's switch to the Forex market now with Christophe.
So let's start the Forex analysis with euro-dollar as usual. The pair remains under pressure below a very strong horizontal resistance at 118.50 we can see here, which is a late May and June top. It remains under pressure and is approaching a very strong horizontal support at 115, which was the bottom of May and June. A break below this horizontal support will lead to further weakness toward 113, which is a very strong horizontal support and previous overlap of previous June and July 2017. Only a break above 118.50 will turn the outlook, the short-term outlook to bullish, with a first alternative target set at the 119.70 horizontal resistance, and then the very strong horizontal resistance at the 121.50 in extension. But currently we remain bearish below the strong horizontal resistance at the 118.50. Let's now switch to British pound versus US dollar, which remains within a bearish channel in place since May. We can also notice that the pair remains capped by its declining 50 days moving average, we can see here in blue. So we remain bearish below this moving average and below the horizontal resistance at 133.40. You can see here, which was a previous overlap back to last October and December. Targets to the downside are set at 127.70 at first, which was last August bottom, and then 125.90 in extension, which is last June low of 2017. Only a break above the horizontal resistance to 143.40 and the upper boundary of this bearish channel, and as well the 50 days moving average will turn the outlook to bullish with alternative target set at May top at 136.20. And now the last pair with dollar yen. So the pair has turned to bullish following the break of a very strong declining trend line in place since late December 2016. So the outlook is bullish on a short-term basis. We can also notice that the pair is supported by a rising trend line in place since last March, and as well by supported by the rising 50 days moving average we can see here in blue. So further advance is expected above the horizontal support at 110.40, with a first target at 114.50 and then 115.50 in extension, which are very strong horizontal resistances. You can see that 114.50 was hit several times in the past. We can see here in May, in July, in October, so at least 3 times. So very strong horizontal resistance. The pair will be capped around these levels, and it will be difficult for US dollar versus Japanese yen to break above very quickly this area between 115.50 and 114.50. So we're in bullish above 110.40 with this area in sight. That is all on Forex. We can now switch to commodities with Rémi.
Okay, thank you, Christophe. Let's start with a view on crude oil on a monthly basis. I would like to remind you the global picture. So we have seen a decline since 2011 with a bottom in late 2015. Since then, we have seen a rebound and a reversal and shoulders that has been validated that is calling for a rise toward the $81 area, which is 61.8% retracement of the decline from 2011 to 2015. So we are close to this level, but not on it yet. We also have one very strong bullish element, which is the upward crossing by the 20 months moving average above the 50 months moving average, something that has not been happening since 2011. So it's also a strong bullish element. However, so that's for the long-term bullish picture. However, on a daily basis, we have seen a huge decline following the downside breakout of the 72 0.5 former support, so it's a kind of a false breakout. So we definitely expect further weakness on a short-term basis, but the downside potential is likely to be limited to something like 4.5 to 8% decline. The maximum retracement should be around $61.8. This area is a very strong support, and we should see additional development, especially because the daily RSI should arrive around a strong support on a daily basis. So the downside potential is likely to be limited, but on the short-term basis, it is here, and we have several bearish elements in place. Only a push above 72.5 would lower the immediate corrective risk and favor another test of the 75.2 former top area, and further advance towards 77.5 and ultimately $81, which is 61.8% retracement, so a very strong resistance. Now let's switch to precious metal, where we have seen an interesting bearish signal happening on gold. Well, on gold, we have seen a downside breakout of a rising trend line that was in place since early 2016. So this downside breakout corresponds also to the downside breakout of a strong support area. It was a previous low from late 2017, which was around 1,235. So this downside breakout has triggered a bearish acceleration, and we should see further weakness toward the 1,210 and the 1,170, which is 61.8% retracement of this up move. So a decline is definitely expected, and you can see that the 20-day moving average is capping prices, so it's a very interesting trading stop on this one. So when we will see a limited rebound, it could be interesting to have this area in mind as a good entry area, and also as a good stop loss and stop and reverse. I would like to draw your attention on the fact that the RSI is strongly overbought, so there is a high risk of seeing a limited rebound in the coming days, especially when we will approach this $1,210 support area. But for the moment, as long as we have this 20-day moving average capping prices, we can definitely expect further weakness. I would like to remind you our different views on the different assets we have covered during this video. So we definitely expect further advance on the US and the European equity markets. We are looking for further advance also on the US dollar against the euro, against the sterling, and also against the Japanese yen. And on the opposite, expect a further decline on crude oil and gold. Thank you for watching this video. We'll see you next month for another 1 month outlook. Happy trading. Thank you.
Bye, everyone.
Thank you. Bye.